Everyone's still kind of in this old model, sort of newsletter model of like assuming that somebody can pick the next Amazon or pick the next Nvidia. It's not going to happen. You're going to keep losing money, throwing money to those, services. But what you can do is figure out how the market's going to react tomorrow, or in a week to something that actually happens, that actually matters to the share price. So that's my why.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Andrew Einhorn. He's a Chief Executive Officer and co-founder of LevelFields, an AI-driven fintech application that automates arduous investment research so investors can find opportunities faster and easier, which I'm sure is an incredibly valuable resource. Andrew, first, I want to say thank you for coming on the show. Thanks for taking the time out today. Interesting that we have some New England connections, so that's pretty cool to find out. But thank you for being here today. I'm excited to have the conversation.
Thanks for having me, Jason. I've listened to your show. You have really good guests, so I'm flattered to be one of them.
Awesome. I appreciate it. Well, let's start. Let's tell people about you. Let's hear your background, and of course, we'll get into talking about LevelFields. But just tell us a little bit about yourself.
Sure. I've had fairly a-traditional career trajectory. Started my career actually as an epidemiologist. And so if I was going to draw a thread through my career, I'd say I'm very interested in looking and analyzing data patterns of human behavior. So started in healthcare, moved into basically public health, intersection between public health and media analysis work. Had a company that I founded in 2009, sold it in 2019. That company did kind of reputation and event analysis work for publicly traded companies. What does that mean? It means like if something bad or good happened to the company, they need to know about it right away. So this could be, a train company that had a train derailment in the middle of the night and it spills chemicals. The chief communication officer needs to know. So we built software to alert them, instantaneously. Likewise, if there's cyber attacks or even just positive things going on with the product launch that resonates with a particular group of people, the software would analyze that, send it over to the corporate comms folks, and they could do what they wanted, with the messaging side. Along the way, I was adjunct professor at Georgetown. I was teaching classes in kind of the intersection between communications and data science at the time, and then doing a lot of research into various other topics to include electronic medical records, building a pandemic monitoring system for Georgetown hospitals, and anything that was sort of that intersection of real-time data and data analysis work to solve problems. And so, at the end of 2019, we started to think about the next problem. We, being the technical team from the last company, got together and realized that, part of the challenge in kind of the investing world is just keeping up with massive volumes of information. Whether it's qualitative or quantitative, there's just tons of it. And so your average investor can't do it, not by themselves. I mean, even a large hedge fund has had a difficult time with a couple hundred analysts working through all the information. And so you're looking at, filings and press releases and news and reports, and you're trying to gauge, what to do and how to make money in the market. And it's really overwhelming. We actually calculated that we're looking at roughly 15 million records a year, through the system. And so what LevelFields does is automates the reading and analysis and extraction of information from all those reports, news, filings, and pulls out just the things that are meaningful. And I think for the average person, if you ask them, how many stocks can you name, you might get 20, maybe 30. You're certainly not going to get the 6,000 that there are in the US markets. And so that's kind of what LevelFields is for, is leveling the playing field between the big guys, the institutional investors, and the self-directed independent investors to try to give an edge. We do that through trade discovery. What that means is we have an event-driven way of analyzing information. So You don't have to be kind of a fundamental analysis guru like a Warren Buffett type. You can keep it relatively simple on the strategy. For example, if a CEO departs of a large company, our system shows that that's a bearish event, and it shows how long that bearish event typically lasts. Is it a day or 2 days or 2 months? That gives opportunities to buy the dip, because you see after 3 months, there's a mean reversion. It goes back to the original price point. We saw that with Amazon when Jeff Bezos left, right? It was like, is this the end of Amazon? It was like the headlines all over the newspapers.
Yeah.
But our data said, no, it usually goes down 2% in the first day, up to 10% over 2 months, and then on to make new highs again later, which is exactly what happened, with Amazon. And that's a lot of what we use in the system. Is it's kind of like common sense or gut reaction meets actual data science. So things that are going to be bad, company starts laying off a lot of people, that's bad. You just don't know how bad it is. And so we kind of fashion ourselves like a weather report. We can tell you, where is it raining? Where is it sunny? How long is it going to rain? What's the chance of rain? Should you bring, an umbrella, or should you bring a full rain suit? How bad is this thing going to be? And allows you to really make data-driven decisions without having to do the guesswork, without having to do the legwork, kind of coming up with your own models, or looking at past performance, taking all that time away. And so what we've ran different experiments to figure out how much time we're saving. It's roughly 1,800 times faster to use this system than to try to do things on your own. So if you value time, this is definitely a platform to check out. And if you want to look at opportunities we have on the platform on a regular basis, 10 to 15 per day that pop up. I'm just looking at it today. There was a CEO hired at a new semiconductor company. Stock's up 17% today. So that's kind of a standard move for these type of material events. Sometimes it's 600% in a day for certain, large contracts that get awarded to small companies. Other times, it goes the opposite direction. It's a bearish event and down 20%, and it's opportunity for, option traders or those who are interested in shorting stocks. And that's helpful when you're not in a bull market cycle, right? You can play both sides and find ways to make money. So I'll pause there. I'm sure you have questions. That was a longer intro than I had planned.
No, that was great, and I think, I mean, certainly your background in epidemiology ties in very well to this. I mean, it makes a lot of sense, because I think my perception of investing in general, like the general public, is it's very, kind of, I guess, psychology driven in the sense that people make reactions to news that they hear. And it's even though that's contrary to what all of the great investors would say you should do, that is in fact what happens most of the time. Like, Warren Buffett's not making emotional decisions on his investment moves. It's all calculated through data. And he has, as you mentioned, like probably a team of analysts plus, his 70 years of experience. So there's a lot that goes into that. But for the average investor like myself, something like this sounds just like incredibly valuable, in the sense that, yeah, you might be able to recognize those events as, bullish or bearish. You may be able to recognize, yes, but knowing how much and how to take advantage of those opportunities, I think could certainly be a game changer. What do you, I guess, just backing up, is this a product that like someone would come to you and say, I want a subscription, or I want to buy? How do people get involved with LevelFields, like, as a user?
Sure. Yeah, there's 3 ways. I mean, we put out a free weekly newsletter, every week, that has some stock analysis and shows some case studies of what happened on the platform and how you could trade that. Next up is the paid subscription entry level, which is a couple $100 a year, which is very cheap for having kind of customizable AI search agents working on your behalf 24/7. And you just come into the platform, sign up, and then it's organized in what we call scenarios. And scenarios are just groups of similar events. So it could be CEO hired, CEO fired, could be a product launch by Tesla. It could be a new activist coming in to turn around a company that has been struggling. And each one has a little bit different kind of win rate and average price move. And you see that right off the bat. So this is like shopping for strategies. You just kind of browse and say, okay, yeah, 80% of the time this one wins. It's bullish. Average 1-day move is 4%. Average 10-day move here is 7%. That looks pretty easy. Let me look at that. And you click a button and you get alerts for every time that event happens. And so the idea is, when you have thousands of stocks and you have these types of events that happen over and over and over again, for some of the scenarios, you'll see upwards of 500 events per year, same type of event. So it becomes, in and of itself, a strategy, a trading strategy. So you can just buy and sell just on the basis of those events. You can all use it for longer term analysis as well, if you want. So there's often like contrarian indicators or indicators of something interesting happening at a macro level. For example, when the war in Ukraine broke out, we started seeing all these events from coal companies and fertilizer companies. They were giving away cash back to shareholders. They were doing big dividend raises. They were doing stock buybacks. We're sort of like, what's going on with these companies? We had no idea. But the system flagged it because it's a material event for the share price move. And so, 2 seconds of looking into it, you realize, oh, well, this company makes a fertilizer. A third of the world's fertilizer of that type comes out of Ukraine and Belarus. There's a war, so they can't ship it out. So what does that mean for the Canadian and American companies? Well, it means that they can raise the price of fertilizer by 200 or 300%, not change anything else about their business because it's supply and demand. And then they were just rolling in cash. And so it was the same with coal. They shut off the pipeline into Europe, and the Europeans had to move to coal-based power. So price of coal goes up. American coal companies in West Virginia start crushing it because they can sell coal for more. And it's a lot of that. You don't need to know necessarily the associations because the platform is figuring that out just by these types of events that are being flagged. So there's a lot of education, I think, that's embedded in the platform, which I feel maybe underrated for some. But when they start watching and looking at a chart, if you go to Yahoo Finance or something and you see a chart, there's ups and downs and ups and downs. You don't know why. You have to really go back and forth between a news feed and the chart to figure out, why did this thing fall off a cliff, 3 days ago? This looks like a dangerous stock to buy.
Yeah.
And then you might see, oh, well, they just did, a huge cash dividend. They gave away a lot of their cash, so the share price came down. We would have that right on our charts as a, explanation. So you don't have to search around for it. You might see a company that crashes, and right before the crash, we'll have on our charts, there was a bankruptcy filing. So it makes a lot of that investment research much faster, much easier, and explains a lot of the day-to-day movements kind of behind the scenes that I would say an average investor would not even know about or understand. But once you see, okay, get it, this type of event moves the share price, and that's why this thing happened, you start learning as you go through the platform. So it's almost like you get better just by using it and seeing everyday reactions to these types of events. And you're right, a lot of the movements these days are behavioral based. There's a lot of technical analysis that's being used. And technical analysis is interesting because it's all just patterns in charts that people are following. But why did that pattern occur in the first place? It always occurs because of an event. It's not just that these patterns just magically form. It's that there are people on the other end reacting to news, or reacting to some kind of filing that the company made, or reacting to a particular valuation. Like in your example of Warren Buffett, he dumped Apple stock the other day. Why? Because Apple hit a historically high price to earnings ratio, and they're value investors. So they couldn't hang on to it. And that was an event, right? That's what we call a metric-based event. So there's always some kind of event that's driving things, and it's just a matter of what do you do with it? How do you trade it? Do you look at it long term? Do you just use it for research purposes? Do you use it to monitor your existing portfolio? and so forth, because you can, on our system, you can take all of your stocks, upload them into a watch list, and then create alerts that are not just price alerts, but qualitative alerts. You say, hey, if I own Apple and the CEO leaves, let me know. I don't want to have to go finding that. Or if Apple suddenly does a dividend increase, let me know, because maybe I'll sell shares on the news. So things like that, you can kind of guard against, or take advantage of kind of the pros and cons of what's happening with your existing holdings. So there's a lot of efficiencies now that we can derive, because effectively what you're doing when using LevelFields is you're hiring an AI speed reader that's just going to read on your behalf, flag things, and say, hey, this is pretty interesting. What do you think? And then you can react or not react. You can filter those alerts to get what you want, or ignore the things that you don't. And you can kind of set up your own sub strategies. So, for example, I don't know anything really about industrial companies. I like tech and healthcare. So when I want to look for events, I only look for events around, predominantly tech companies or healthcare companies. And I don't like to buy, companies that have really high valuations. So then I can set the alert to say, you know what, valuations above this, just ignore it. So now I get a steady stream of events of just the companies that I like to invest in. And it's always looking for that. And the data is always changing. So I don't have to sit there running stock screens, every week to try to find the same type of stocks. So it's been very interesting. It's certainly helped me in my own investing.
Yeah, I'm sure. And your point about the educational piece of that is probably underutilized in the sense that that's maybe probably not why people sign up. But as you're talking to me about it, I'm like, well, wow, that sounds like just a great way to learn about, kind of the stock market and behaviors and kind of how these events create change, even at a very high level. It sounds like your analysis is much more granular as to, percentage changes and things like that. You mentioned a third tier, and I think you only talked about sort of two, the free and then the subscription.
Yes.
Maybe there's something even beyond that.
Yes, thank you. The third tier, basically, you get a little bit more guidance. So that is, you can kind of think of it like the editor's picks coming through. So our analysts will sit there on the terminal for you, or just look at their inboxes, and when alerts come through, they sort of cherry pick the ones that they think are going to be the best based upon years of watching the data and building the system. They'll flag it, and they'll send kind of a human-driven alert that says, this is what just happened. Here's what we think is going to happen with the share price based upon, historical data. Here's our rationale for choosing this as an investment. And by the way, here's 30 other factors that you might not know about. Right? I mean, we'll look at, what is the macroeconomic environment? Does it support the thesis that this will continue to go up? For example, stock comes through and they say, yeah, it's a biotech company. They just did a stock buyback, which is really rare. What else is going on with this company that would make them so confident? And then we look up and we say, okay, yeah, they just got a new drug approved by the FDA. Macro environment is such that interest rates are coming down, so their loans are going to be cheaper. So more money for them means more research, and also means more of a sales staff. And so we make this sort of 360-degree analysis of why we think not only is this like a bullish event for the stock, but how far it's going to run. And that has actually been our kind of most successful level, because it's done so well. We send about 50 to 100 trades like that per year. The cumulative return since we launched the program is about 4,000% for the closed trades. It's been pretty amazing. And that's really just following the data. We don't put any real human bias in it. We're just like, here are all the catalysts that are happening, and here are the headwinds, here are the tailwinds. This is why we think it's going to, this is what the data says it's going to do. And so we make that assessment. So that one's more expensive. But, if you don't want to spend the time learning the system, if you don't want to spend the time watching the markets at all, but you want to kind of take advantage of this different way of approaching the market, which is more kind of opportunistic. We really look for pricing discrepancies caused by events. That's kind of the core thesis, right? And that could be a day long, or it could be 6 to 12 months. It just depends on kind of what's happening. And at the end of it, it's like value investing, but it's short-term value investing, right? Because we don't think our general philosophy as a company is we don't believe you can pick stocks 10, 20 years out into the future. History has shown you can't do that. GE in 2002 was the biggest company on the planet.
Yeah.
Now, 20 years later, it was still under the price it was in 2002, and now it's in a bunch of different pieces. So the buy and hold thing really only works if you are an expert at buying the top 3% of companies of all time.
Right.
And the other 60% just fail completely. So what you can do, though, is you can predict maybe a couple days out, a couple weeks out, a couple months out, maybe a year out, right? You have strong conviction that time period. And you can utilize the data to see where the momentum's coming from, because our environment's always changing. We've got leadership changes coming in the presidency. That's going to lead to policy shifts. We have political turmoil. We have global conflicts that arise, weather patterns that change the nature of companies, technology that rises and falls on the basis of how things are doing, like CrowdStrike on one end, and over on the other, sort of robotic guacamole makers like Chipotle announced this morning. So there's nothing static about our world right now, and things move really fast. And so it's if you hear, oh, this is the next Amazon, like, it's garbage. No one can figure that out. What you can figure out is what the next year, maybe 2 years down the line, are going to look like. And so that's kind of where we focus our energy to get higher returns in a shorter time period.
I think that's super interesting, and 4,000%. What was the time frame on that?
2 years.
Yeah, that.
Yeah, it was.
Nobody's going to be sad about that level of return. That's phenomenal.
And if you look at it, I look back on kind of the ledger relatively frequently, and there's a lot of like 40-50% gains, and they just add up over time, 20, 30, 40%. And then a couple big ones, like, we saw when Signature Bank was folding, we suggested to our users, like, buy some puts on this because it looks like this thing might implode. And so, of course, that ends up with a 500% gain. So you get those outsized moves, particularly from using some of the option contracts.
Yeah, so you're really talking about picking, with this AI-driven data, you're talking about picking stocks, right? Because the traditional, traditionally it's like, oh, if you're going to invest in the stock market, you should just get, a mutual fund or an ETF that covers the S&P 500 and just leave it there forever, right? Like, but you just said that doesn't, that's not really the way that, the buy and hold, that's what a lot of people do. And unfortunately, some people are paying their financial advisors and planners to do that for them, which is like, that's not investing. You can do that on your own without paying someone a fee to do it.
Right.
You're talking about, sort of creating data-driven decisions on individual stocks. And it's, and that, for the record, like, that's what Warren Buffett does. Like, Warren Buffett doesn't just go out and buy the S&P 500. Like, he's picking the stocks he wants. So people, we all point to him probably as, sort of the greatest investor of our generation. What do you say? I've talked about this before on the podcast. The S&P 500, you mentioned there's 6,000 stocks, there's 500 in the S&P 500, but really all of the growth in the S&P 500 of the last year has been from the Magnificent Seven. Like, everything else is down, basically. Like, everything else has lost money. And to me, this just, LevelFields, what you're talking about makes so much more sense. And using AI to derive that data is probably the only thing that can keep up with the pace of the way that things change. Like, 20, 30 years ago, you're not going to have that same level of information transfer that we have now. And so you like a single person, it will be extremely hard for them to keep up with, kind of what's going on. And even the big stuff, like you've already mentioned several things, like the Chipotle thing. I didn't know that. Like I didn't hear that today. It's like if I was a Chipotle investor or wanted to be, that would be interesting information to have and sort of get into it with that, kind of in mind. So, I mean, I see this as really pretty contrary to what the general public think of when they think of stock investing. Do you agree? Like, what's your take on that?
So a couple of things. I would say, buy and hold on individual stocks for a long time is very risky, because the likelihood that that company is going to continue to outperform and not go through periods of decline is pretty low, right? It's unlikely. Even Apple was almost bankrupt company at one point before Jobs did the turnaround. Amazon, almost a bankrupt company. Microsoft, got slammed with monopolistic practices, and they, forced them to sort of break up the company. You have companies that don't exist anymore, companies that are filing for bankruptcy left and right in the food industry. BurgerFi, I think, was the most recent one that I saw. So it's very difficult to have an environment where you can just put your money into a few stocks and just let it ride. The indexes are better because they are rebalancing their compositions, right? So I think a week ago, 3 companies, I forget what 2 of them were, but one was Etsy, got kicked out of the S&P 500, mostly for underperformance. And then, the companies get added to the S&P 500 because they are performing well. And so like the index investing for S&P 500, it works over a long period of time. Mm-hmm. The problem is there are massive drawdowns in various years. We had one in 2020. There was one in a little bit in 2018, sort of tail end, massive one, 50% drawdown in 2008 with the global financial crisis, 60% drawdown in 2000. You have to be able to withstand that kind of shock to the system, shock to your investment portfolio, in order to get past that. And very few people can tolerate that or don't need their money for that period of time. So if you don't need access to your money, fine, put your money into an index, make your 7 to 9% per year. You're going to have some bad years. If you don't look at your statement ever, you can wait 30 years. That's great. But if you start to look at it demographically, that's unlikely, right? Because you have older population. If something bad happens and you're 75 years old, you do not have 20 years of waiting for recovery.
Right.
And there are long periods of time in the market where the S&P did nothing. I think from 2010 or 2009 to maybe 2016, 17, there was no return in the S&P 500. So you're going 6 or 7 years flat following, a massive dip. And if you're of a certain age, that's not a viable strategy, right? Likewise, if you're getting started in the market and you don't have a lot of money to put into it, making 7-8% a year is really not going to turn you into a millionaire or get to whatever your goal is. Yep. So you need strategies in addition to that are going to be able to generate more income. They're going to generate wealth faster. They're going to turn, even if you just look at the rule of 72, right? Take 72 and divide it by whatever the return is per year. And that's the number of years it takes to double your investment. So 72 divided by a 7% return, it takes 10 years to double your money. But if you make 50% in a year, you're really doubling your money almost, a little less than every 2 years. So those have like massive effects. I wouldn't say, it's one or the other. I say you got to break out into different strategies. Some long-term, some shorter term, some large cap, right? Some that's maybe dividend focused. And we're just one of those strategies to have. That's like, I'll take 5 to 10% of my portfolio and I'll put it towards this sort of event-driven investing. And if it does well, maybe I'll allocate more towards it. I have my long-term, 401k that I'm not going to look at. So it's additive. But at the same token, when things go badly, or when you get into an environment that's very volatile, where you don't know what the future holds. And I think we're in one of those patterns right now. We're sort of like, is this a soft landing? Is this a hard landing? What's going on with the $36 trillion worth of debt? Are they going to pass a budget in Congress this year?
Yeah.
Are we going to get another Moody's downgrade? What's going to happen with all this global conflict? Like, we're at that moment where if you're holding on to a lot of stocks, you could see a massive downturn very quickly. Now, on the other hand, if you're in cash and coming in and out of positions very quickly, you can make 7% in a day. Go back to cash safely. You don't have to wait, 350 other days to make that 7%. So, yeah, those are strategies to use in a volatile market. Go back a year and, or go back to 2021, we're just throwing money out at everybody, and it's a massive bull run. That's the time you can just buy the index and let it rip. But for certain times, this makes more sense, and particularly in bearish environments too. Like in 2022, everything's going down, it seemed, but the truth was there were pockets of the market that were performing really well, that were interest rates sensitive on the positive side. And so you have to be able to know where to look and how to find that. And if you don't know, because you haven't spent 20 years, in Wall Street or, managing money, this is the only way to do it. You have to have the AI looking for those opportunities. Say, hey, I found, I looked through 6,000 stocks. I found these 3 bullish events. Why are these companies bullish? Well, war is good for some companies.
Right.
Raytheon and Lockheed Martin, and it's a great time for them. Crappy time for everybody else. So that happens. But if you're, not so savvy that you can connect the dots for the global economy on every data point, which is, I think, 99.99% of people, you need a little extra help of like why these things are happening. And so that's what we're built this platform to do. And we're going to continue building, to make it better and faster and look at more things, put things together for people. So I'm excited by it. I mean, love it. I use it myself every day. Told my wife when I started the company, like, one way or another, it's going to be successful. If not for, the business purpose, I'm going to use it for myself and still make money, which I have been. So,
right. Yeah, you're going to make money selling a product, or you're going to make money, because the product works. And it's honestly like super smart. I was never really an educated stock investor. I got into it and, picked companies that made sense to me. I never really, I don't know. I never liked the idea of just, I'm just going to put this in, a mutual fund or whatever. I wanted control of it, and I made some good decisions and some bad decisions, and that's fine. But I think that I've shifted a lot of my like investable funds away from that and into real estate, because I just didn't love the sort of volatility of the market and things like that. But doing it this way sounds much more appealing to me in terms of, if I want to, I guess, shift some money back towards investing in stocks. It just makes a lot of sense to me as far as the way it should be done. And I'm certainly not knowledgeable enough or have my own team of analysts to figure all that stuff out. Like you said, it's nearly impossible for most people to keep up with everything that's going on. Having this tool to help you make those decisions is, I think, tremendously helpful.
Yeah, and we see that, we sell it for the entry price is a couple $100 a year. So I always tell folks, like, if you found one good trade, one good stock, you should be able to make $200 off of that stock,
right,
or off of that trade.
Right.
Very, very simple. If you can't, probably not investing with enough money, which means you probably shouldn't be investing. But $200 in the course of a year for like a little bit of a return on a stock or a trade is, I think, a pretty reasonable assumption. And we certainly see, thousands of percent return from the platform if used regularly and, along the lines of the guidance, of the scenario. And there's a lot of help information on the platform to sort of showcase like, hey, this is how you use this event, and this is how you use this type of alert. So we try to walk as much as we could, folks through that process. And some of it is just understanding the mechanics of the market. Like, why is September a bad month? If you ask, I think, an average investor, they wouldn't be able to tell you. But historically, it's 60% of the time, the month of September is down in the stock market. It's not just because the weather gets worse and people get into bad moods. It's because large asset managers are looking at the end of the year coming up and saying, you know what, I'm going to trim some of my gainers. I'm going to sell some of the losers so I can offset the gains for tax purposes. And that almost always happens in September. And they're moving around billions of dollars. So you get this like massive volatility. Right. For an average person, they're like, this is so mysterious. Why is the market crashing? But it's a mechanical thing, and it just happens all the time. Likewise, for momentum algorithms that trade off of technical signals, which are reacting to events. So if you know the event, then you can kind of predict this series of events, right? So the event happens, stock price goes up, the algorithms see the stock price go up, and a technical indicator, showing a bullish engulfing, indication on the chart. And all of a sudden, the momentum algorithms buy that shares. Those who are day trading or watching the market are seeing these massive moves, 9-10% in a day, and they jump on it for momentum, so it pushes it up more. And that's pretty common. And so we can see that in the patterns on the software platform. And, if you're there, and I think everyone's had the same experience when you turn on the TV and they're talking about some stock that's up 300% for the year, and you're like, why the hell didn't I know about this stock a year ago? Why are you torturing me with this information now?
Yeah. Yeah.
And we try to find like, what are the early signs that big run is about to happen? And there's, we have one scenario that is technical indicators and many that are based upon actual events. But you see it constantly, and you see this like back and forth. I know often it's intentional manipulation because they march out these billionaires onto TV and they start talking about how they love these stocks. And you start to see the price of those stocks go up while they're talking because everybody's watching. Of course, they're dumping the stocks as they're talking about the stocks because it's not like you or I that's going to sell 100 shares, 1,000 shares. They have to sell 10 million shares. They need enough buyers. So they have to drum up interest so they can offload it. So there's no such thing as good free advice in like the market. Like usually there's some string attached. So if you're getting something for free, it's the advice on stock picking is worth what you paid for.
Yeah, makes sense. Makes a lot of sense. I mean, I think this is fascinating. Well, let me shift gears, Andrew. I want to get to ask you the questions I ask each guest. And the first one is based on the name of the show being Know Your Why. So I always ask everybody, kind of what is your why? What's driving you? I think that this is really a fascinating platform and could provide a lot of value to people. What's your motivation behind what you do?
I mean, it's baked into the name. We really want to level the playing field for a self-directed investor. We think that the scale of the game is tipped too far in favor of large institutional money. And now we're kind of arming people with the right tools to participate at the level that, we see these large hedge funds or asset managers being able to do. And that's what motivates me, right? It's like, it's nice. The making money part is great, but that's not what gets me out of bed in the morning. It's not what gets me excited. It's like, okay, well, what can we do with this data to make it easier for people to improve their livelihoods, by increasing their finances, by improving on their finances. Right? That was the impetus for creating it. And I've mentioned this to my wife several times. Like I could make more money doing something different. It's not just about that. It's like, how do you participate in society and contribute to some good? Mm-hmm. And for years, and it still happens. There's a lot of market manipulation. People get fleeced all the time. I had friends lose a lot of money in the market for dumb things and dumb reasons, like, jumping into GameStop when the price of GameStop was $400 a share and losing, $80,000 because they didn't know what an average short squeeze looked like.
Yeah.
And I would say, hey, man, why didn't you ask me? I could have told you. Like, they rarely go more than 10x. You were at about 15x, and you put all your money into it. And so, safety guardrails,
Yeah.
for
Yeah.
things like that, just to give people a better opportunity. And we had some very difficult times during COVID. When COVID first happened in March 2020, and the market was selling off, and it looked like we were going into possible depression. People were, family, friends were very scared that I was talking to, and they didn't know how to react to that event. I happen to have a weird set of skills where I was an epidemiologist who had worked for the CDC during the last epidemic in swine flu, going into financial data analysis, and found myself in a weird place where I could just crunch the numbers, look back into the historical data, and come out with an assessment of what I thought the market was going to do 6 months later and how the government would react. And I said, we're going to be fine in 6 months. They're going to have a vaccine in 13. And I got a lot of nasty comments on like that assessment at the time, but it turned out to be true because I was just looking back saying, they did swine flu vaccine in 11 months. If you look at Zika, cruise ships and airlines sold off. They closed the port of Miami. They closed the schools in Miami for Zika virus. Few of us, the rest of the country knew that. And so you have these mini COVID events that you could look back and be like, okay, I got the government response to this. Like, once there's a transmission in the country, it's bad. Once that transmission becomes, intra-country, like someone gives it to someone else, then the market really reacts. And so it becomes predictable because you know what the government's going to do, you know how the traders are going to react, and there's a playbook for these things. So, when I was talking to family members and they were worried they were going to lose their retirement, they're worried they're going to lose their kids' college fund. It became crystal clear. They're like, we just need a data analytics array around events so that when something happens, you know how to react or what typically happens. You don't have to just sit there and wonder and worry or wait 4 weeks until Goldman Sachs, sends out their COVID stock conviction list, of which they've already bought all the stocks on, and then market it to everybody else. You can do it before then. You can have those reactions. So it got personal then, and it sort of crystallized the approach that, why isn't there like a weather forecast for stocks?
Yeah.
Everyone's still kind of in this old model, sort of newsletter model of like assuming that somebody can pick the next Amazon or pick the next Nvidia. It's not going to happen. You're going to keep losing money, throwing money to those, services. But what you can do is figure out how the market's going to react tomorrow, or in a week to something that actually happens, that actually matters to the share price. So that's my why. Definitely keeps me motivated, and sort of the North Star, like how do we keep making things easier for people? How do we get to an answer is kind of the way that we talk about it internally. Let's not provide data, let's provide answers. There's enough data. People want the answer.
Yeah, that's great. When people hear this and they want to connect, what's the best way? You can give us the website, how they would connect to you, anything, and we'll put everything in the show notes too.
Yeah, just go to levelfields.ai is the website. You can read a lot of our case studies there. We have news that we put out on a regular basis. We have a YouTube channel where we actually put different stock tips and stuff out for free as well. If you want to write in, just write support@levelfields.ai. And if you're listening to this and trying to wonder if this is for you or not for you, you probably know somebody that this will be useful for. Appreciate the referral to that individual. There's a promo code for getting a discount. You can put in the word podcast to number 23, so it gets you a little bit off, and hopefully check it out.
Awesome. No, I'm definitely going to check it out. I think it's fascinating. Andrew, thanks for coming on the show. This was super interesting. To be honest, I wasn't exactly sure what to expect with all of this, and I think it's a tremendous platform. And I said I'm very interested, and I think other listeners will be as well. So thank you for coming on. Thank you for sharing everything. I appreciate it.
No, thanks for having me. Yeah, had a good time. Appreciate it.
Absolutely. Folks listening, I know you're going to find this super interesting. Make sure you check out LevelFields, connect with Andrew, and please like, rate, and review the show so we can get more great guests. And thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?